I'd like to thank everybody for joining me today. Today, I want to talk about using irrevocable life insurance trust. I think, using irrevocable life insurance trusts have, you know, in general have been declining in use. And for so many reasons, it just comes down to, the complexity. And in many situations, we're just relying on the estate tax to dictate what type of tools we're using. But there's so many other reasons beyond estate taxes for using life insurance trusts. As you get into the planning process and you think about the other planning issues, what about asset protection? What about controlling distributions to our kids or grandkids? Using irrevocable life insurance trusts can go way beyond just the estate tax conversation. When you look at how life insurance can be owned, typically we stay with individual ownership, and there again, we want to keep things as simple as possible. But let's start looking beyond just simple, because simple's the easiest way to go. If individual ownership is what's needed, great. Do we want to put it into the revocable trust? Maybe we can have ownership individually and the beneficiaries into the revocable trust. There again, to fill out the rest of the estate plan and make sure that we're handling distribution to the heirs the right way. If we continue on, should the policy be owned by the business? Is it a business use policy? Now, when we're talking business use policy, do we need the death benefit and the cash value inside the business? If you're a sole proprietor, sole owner, majority owner, maybe you want that policy outside of your estate. And then upon death, that money can be loaned to the business. There again, we're getting asset protection, we're getting estate tax control, and we've got flexibility to use that in the business if we need it. Finally, using an irrevocable trust. A lot of times I hear about irrevocable trusts. Well, they're too complex, or irrevocable trusts are taxed at a high rate. I hear that from a lot of CPAs, which the answer is yes. The income tax held within an irrevocable trust hits the top, income tax, marginal tax rates extremely early. But there again, if it's life insurance, we don't have an income tax problem because the policy is not going to generate any income tax. So having that policy inside the irrevocable trust is not an income tax issue, but it can solve so many others of our planning problems that we're facing with the client. When you look at planning is a balancing act. In a perfect world, in a vacuum, we can get to a lot of solutions. But when we get into planning, we're always making sure that we're balancing everything appropriately. And part of that is when you're starting to look at the life insurance and life insurance trust, what assets can we transfer? What assets should we transfer? Once we decide what assets, that we can transfer, how much of that should be put into trust? There again, if it's not an estate tax issue, then we've got other factors that are going to dictate how much of that we put in trust. If it's an estate tax estate, then of course we're going to be looking at how much of that can we get out of the estate. But there again, it's a balancing act to make sure we're taking care of our clients today, and we're making sure that we can move the assets out of the estate, out of, into asset protection, into a better tax environment. All of those issues are going to be the balancing act that we have to step through. I hear this a lot. Well, if I move assets into an irrevocable trust, I don't get a step up in basis. 100% correct. If the assets are in the trust at death, there's no step up in basis. Let's take a step back to what assets are we going to transfer into the trust. Now, if I've got low basis real estate, maybe that's not the right asset to put into the trust. Let's look at, maybe it's an investment account, that's got a high basis. Maybe we have other assets with a high basis. Maybe it's just assets we want to protect from creditors. There again, step up in basis is one of those planning tools that we have to balance out to make sure we get the right result. Finally, we've got to look at, what about lifetime needs? We don't want to lock things up into an irrevocable trust if we're going to need it during the client's lifetime. So making sure we have all of this set up is the right way to do it. Now, let's start looking at how can we use an irrevocable life insurance trust and still get the assets out of the estate, but with lifetime spousal access. Now, these are provisions that we have to make sure the trust is drafted up, correctly to make sure that we get this. So let's look at this. We're going to have husband set up a trust for his wife. And in this case, the husband as the grantor is going to determine what are the goals and objectives of the trust. What provisions does he want to include in that trust for his wife? And once it's all set up, the grantor's job is to make sure assets get put into that trust either now or over time to make sure that the trust can function properly. Now we can have a grantor trust status. That grantor trust status just means any income tax generated in the trust will be taxed back to the grantor during the grantor's life. Now, if it's husband and wife, not a big issue because they're both responsible for those taxes typically on a joint return. But if we have this for kids, grandkids, that grantor trust status can be huge. In this case, when we set this trust up for, husband sets it up for wife, the wife can be the trustee of this trust. So she can be the trustee of a trust set up for her benefit as long as we have the right provisions in there. Now, during the wife's lifetime, she can be the lifetime beneficiary of this trust. And in this trust, we can add spousal lifetime access provisions. So the wife can, in this case, as trustee and as beneficiary, can set this up and she can reach into that trust and withdraw as much income and as much principal as she wants, as long as we have the provisions set up in the trust properly. What I like about this, we're getting assets out of the estate, but the what if we need more lifetime benefit? What if, in this case, the wife needs access to that money during her life because, we had an implosion of asset values in the estate. We've lost access to cash flow, whatever it is. What if she needs access to that? And plus we can do the exact same and almost do an identical trust for the, wife setting it up for husband. If we want access for both spouses, we just have to do two separate trusts. At wife's death, we can pass that on estate tax free to the kids, grandkids, keep it in trust, keep it there forever, whatever we want to do. Now, let's think about the non-tax reasons to do this. I like perpetual values inside of the trust. What incentives, in this case, husband setting it up for wife that passes to the kids, but any irrevocable trust, the grantor gets to decide, what do I want to influence? What do I want to encourage? In some reasons, what strings do I want to pull? Do I want to have special needs language in there? Do I want to encourage education? Whatever it is, whatever important to our client, they can put that in the trust. Now we can put incentives in there. We can also put disincentives in there. Basically the things I don't want my money used for. If my child or grandchild has a drug problem, well, I don't want to feed them cash. I want to get them into drug rehab. I want to make sure I take care of them the way that they should. So we can have incentives, we can have disincentives. There again, non-tax reasons to have an irrevocable trust. The nice thing about setting up an irrevocable trust, we can pick and choose where we set it up. Some states have more favorable laws for irrevocable trust. We can set it up in a Wyoming, a Delaware, a Nevada, and have a trust that lasts forever if we want with the dynasty trust provisions. There again, think what's best for our client. Once we have all this set up now, we have to look at how do we get money into the trust? And if you look at all of this, these are great ways to move money into the trust. We either have to do it as a loan or we have to do it as a gift. There's no other way to get money into that trust to get it going. Once there's property in there, you can use the income that's in there to handle the life insurance premiums. But as we look at this, we just have to make sure we get the money in the right way, the best way possible, depending on our client's situation. So I appreciate everybody getting on. If you have questions, feel free to reach out. And if not, we'll talk again next week. Thank you.